Hello, welcome to my YouTube channel HS Podcast Blogger. Today's topic is mutual funds. How and why to invest in them. What is a mutual fund? Mutual funds work by pooling cash together from numerous financial backers. That cash then becomes acclimated to buy stocks, bonds, and different protections. Since common assets put resources into an assortment of organizations, they offer moment broadening, along these lines lower risk, to financial backers. Common asset financial backers share in the asset's benefits and misfortunes. How do mutual funds work? When you buy shares of a mutual fund, you're purchasing a right to a portion of the returns earned by the fund's portfolio of stocks, bonds, and other assets. Mutual means that you split the profits and the losses with the other investors in the fund, says Brandon Renfro, a certified financial planner and assistant professor of finance at East Texas Baptist University. A mutual fund earns dividends and interest from the various investments held in its portfolio. Fund managers can choose to reinvest the profits or distribute them to their investors, depending on their strategy and overall market conditions. When the managers generate capital gains, or losses, by selling assets, they're also passed on to investors. Mutual also means that the performance of a mutual fund depends not only on the fund's manager but also on the behavior of the investors. When holders sell their mutual fund shares, the fund manager may need to liquidate holdings from the portfolio. The sale of those assets could be ill-timed, resulting in losses for the fund which may be passed on to the remaining investors. Why do people buy mutual funds? Mutual funds are a popular choice among investors because they generally offer the following features. 1. Professional management. The fund managers do the research for you. They select the securities and monitor the performance. 2. Diversification, or don't put all your eggs in one basket. Mutual funds typically invest in a range of companies and industries. This helps to lower your risk if one company fails. 3. Affordability. Most mutual funds set a relatively low dollar amount for initial investment and subsequent purchases. 4. Liquidity. Mutual fund investors can easily redeem their shares at any time, for the current net asset value plus any redemption fees. Types of mutual funds. Mutual funds are divided into several kinds of categories, representing the kinds of securities they have targeted for their portfolios and the type of returns they seek. There is a fund for nearly every type of investor or investment approach. 1. Money market funds. Low-risk mutual funds that invest in money markets. 2. Bond funds. These funds invest in corporate or government debt and are oriented toward generating income. 3. Equity funds. Higher risk stock investments that can generate greater returns. They can be focused on large cap, mid cap, or small cap stocks. 4. Balanced funds. A blend of stocks and bonds that attempt to balance income and growth. 5. Index funds. Passively managed mutual funds that attempt to duplicate the performance of an underlying index, such as the S&P 500. 6. International, global funds. These funds invest in overseas assets to provide more diversification. 7. Specialty funds. Industry-specific funds offer targeted diversification, but may also come with higher risk. 8. Target date funds. A complete portfolio of investments that adjusts its mix of stocks and bonds over time for investors with a target date for retiring. 9. Exchange traded funds. A twist on the mutual fund is the exchange-traded fund. These ever more popular investment vehicles pool investments and employ strategies consistent with mutual funds, but they are structured as investment trusts that are traded on stock exchanges and have the added benefits of the features of stocks. 10 income funds. Income funds are named for their purpose, to provide current income on a steady basis. These funds invest primarily in government and high-quality corporate debt, holding these bonds until maturity in order to provide interest streams. While fund holdings may appreciate in value, the primary objective of these funds is to provide steady cash flow to investors. As such, the audience for these funds consists of conservative investors and retirees. Because they produce regular income, tax-conscious investors may want to avoid these funds. 11 money market funds. The money market consists of safe, risk-free, short-term debt instruments, mostly government treasury bills. This is a safe place to invest your money. 12. Fixed income funds. Another big group is the fixed income category. A fixed income mutual fund focuses on investments that pay a set rate of return, such as government bonds, corporate bonds, or other debt instruments. The idea is that the fund portfolio generates interest income, which it then passes on to the shareholders. What are the benefits and risks of mutual funds? Mutual funds offer professional investment management and potential diversification. They also offer 3 ways to earn money. 1. Dividend payments. A fund may earn income from dividends on stock or interest on bonds. The fund then pays the shareholders nearly all the income, and fewer expenses. 2. Capital gains distributions. The price of the securities in a fund may increase. When a fund sells a security that has increased in price, the fund has a capital gain. At the end of the year, the fund distributes these capital gains, minus any capital losses, to investors. 3. Increased NAV. If the market value of a fund's portfolio increases, after deducting expenses, then the value of the fund and its shares increases. The higher NAV reflects the higher value of your investment. Things to know. 1. Risk. The level of risk and return depends on what the fund invests in. Mutual funds are not guaranteed or insured by the Canada Deposit Insurance Corporation, CDIC, or any other government agency, even if you buy through a bank and the fund carries the bank's name. You can lose money investing in mutual funds. 3. Past performance. How a fund has performed in the past can't tell you how it will perform in the future. But past performance can help you determine how volatile or risky the fund's returns may be. 3. Price to buy and sell. You buy mutual funds at the fund's net asset value, NAV, plus any sales charges. Mutual funds are redeemable. You can sell your mutual funds at the current NAV less any fees and charges for redemption. Understanding fees. As with any business, running a mutual fund involves costs. Funds pass along these costs to investors by charging fees and expenses. Fees and expenses vary from fund to fund. A fund with high costs must perform better than a low-cost fund to generate the same returns for you. All mutual funds have fees and expenses that reduce your investment return. 2 ways to make money on a mutual fund. Capital gains. If you sell your mutual fund for more than you paid for it, you will have a capital gain. If you sell your mutual fund for less than you paid for it, you will have a capital loss. Distributions. Depending on the type of fund you buy, you may also receive distributions of dividends, interest, capital gains, or other income the fund earns on its investments. You can choose to receive distributions in cash or have them reinvested in the fund for you. Unless you ask for the distributions to be paid in cash, the mutual fund will usually reinvest the distributions for you. Where to buy mutual funds. 1. Bank and trust companies. 2. Life insurance companies. 3. Credit unions. Mutual fund dealers. 4. Investment firms. 5. Mutual fund companies that sell directly to the public. Avoiding fraud by law. Each mutual fund is required to file a prospectus and regular shareholder reports with the Securities and Exchange Commission. Before you invest, be sure to read the prospectus and the required shareholder reports. Additionally, the investment portfolios of mutual funds are managed by separate entities known as investment advisors that are registered with the SEC. Always check that the investment advisor is registered before investing. Financial advisors who sell mutual funds are required to be registered with their provincial securities regulator.